Okay, hello everyone. Eddie again. So here we're talking about why we trade futures options versus equity options. Well, again, like I said, don't get me wrong. We are not against equity options. It's for this special course, this specific one that we trade futures options because it requires less capital. It is manageable by, a wider population, a wider customer base because it only requires $3,000 to $5,000 in your account and you can trade and make money on a daily basis. So that's why we are comparing futures options here versus equity options. We're not saying one is, well, we do like futures for leverage, but we're not saying equity options are bad. I trade a lot of equity options short side of it. So anyway, capital efficiency. So futures options uses spend margining. Now this is spend margining is basically, it's CME's way of calculating risk uh, on a continuous basis. So they will margin your account based on the volatility in the market, based on expiration of these contracts, based on a lot of different things. So that's what they call span margining. And I should have put this the long form of the span, what it stands for here as well. I think it's something. I'm not entirely sure. But anyway, on the stock side, it uses Reg T margining, meaning you have to put down 50% of the stock value, right? So for example, you're buying one stock of Apple, which is, let's say, trading at $100, you have to put down $50 to get that one stock. The remaining 50 can be on margin. So margin here is different, right, on stocks and futures. On the stock side, margin means uh, you're putting money down to own something. You're owning one stock of Apple by putting 50% of the value down. On the future side, margining is actually a good faith deposit. So you only put down, I think, 10 to 12%. When we saw that in the previous slide. I think 9% is the average, 9 to 12. It also depends on the broker, to be honest. Different brokers use different margining percentages, but on ES, I think it's about 9 to 12%, roughly, 8 to 10, 8 to 10, 8 to 12, around that mark. So futures trade 24 hours a day. We do have well, actually, this should say 23 hours a day because there's a 1 hour maintenance period every day. So I'll change this. Sorry, it's 23 hours, and it's off on Saturday. So they finish trading on Friday, 5 p.m. Eastern, 2 p.m. Pacific, and then they open up on Sunday, 3 p.m. Pacific, 6 p.m. Eastern. Right? Options trade during market hours. The best thing about futures, there's no pattern day trading rule, which I hate the most. It's the most stupidest idea out there. Pattern day trading rule does not apply to futures or options on futures, to be clear. It applies on equity options. And you can diversify into commodities, interest rates. Well, you have ETFs that are built out of futures commodities futures. So on the stock side, there are ETFs, for example, BITO, which is, sorry, for example, let's say GLD. GLD is a gold ETF. This is the gold miners. Actually, that's the wrong example. Let's look at the oil ETF, USO. I think USO is built out of futures contracts on WTI crude. So you do have exposure there. But again, on one hand here on the options future side, you are trading the actual market by these options. On the stock side, you're trading ETFs, which has a big drag on the rolling side of things and multiple different things going on there. So this is the reason why we trade futures options. Next one, um, why trade? Again, this is continued here. So this is some numbers in in perspective here. Let's look at some numbers. So for example, now don't worry about this gibberish here on this side. When I say gibberish, I mean this part. Do not worry. All this is saying is I'm selling one vertical. I'm selling a put spread. Uh, when my strike is 41.70, the short strike, and my long strike is 41.50. That's all this saying. This one is saying it's a December contract, which expires. This is the options on the December contract, right? The futures expire in December. Fine, we saw that. The option on that future expires on October, in third week of October. Okay, that's all this it is saying. There's one contract here. I'm selling one contract, and I'm selling. I am on the short side of it. I'm selling a put spread, and I'm collecting $3. That's all it's saying. That I'm collecting $3. So this is the futures example, and on the right I've put a exact same thing, well not exact same thing, but I've tried to match the max profit. So in order to collect the max profit, the same amount of profit in the SPX index, you have to sell a $10 wide put spread. In the futures market, you have to do it at $20, and for the reason for that is there's a multiplier involved here. 1 out of 50. You see that's the multiplier we talked about, right? In ES. So it just divides everything by two. The whatever you collect, like whatever it says on the screen, $3, you divide that by two, and that's your max profit. Whereas on the index side, whatever you collect is actually your max profit. There's no one divided by 50 here, if you see that, right? Okay, max loss, same thing. I've tried to match max loss. It's $1,000 spread, right? $1,000 is $10 wide in the SPX. It's $20 wide in the ES contract. That's $1,000 spread. So our max profit is the amount of money we collect, the premium we collect, which is this, which is also 150 on the SPX index side. What else? Cost of trade. Yes, cost of trading is higher in futures because you pay futures fee, NFA fee, and the exchange fee. Well, yeah, it's $4 something for the futures contract for CME, and then there's some other fee that I'll show you on the platform. Buying power. This is the main reason why we use this. How much money will I spend to put this trade on? $350 in the futures market, $846 in the SPX market. Why should I put 3 times more money, or 2 times more money at least, 2.5 times, to trade the exact same thing, get the exact same amount of money? Why should I put this? Why should I put this down when I can do the exact same thing in the fusion market, right? And the risk reward is exactly the same here. You're collecting 150. Your max loss is 850. You're collecting 150. Your max loss is 850. Yes, you pay a slightly higher fee, which is double, I would say, right? Double from the index fee. Fine. But I can use the remaining cash to put another trade on, and I can make double the amount. I can cover this extra cost. I can cover, whatever other cost I can get. So this is the reason why we use futures. Now again, don't get me wrong, this is the initial margin. It's based on the span margin. This thing can go up as well, but it will never be as close to as this. Well, it can be, but highly unlikely. So this is the gist of it. Why do we trade futures options? Let me show this to you on the platform as well, really quick. Okay, hello, we are back on the platform. I'm looking at the same contract, 30 days now. Yesterday, the same contract was 31 days because I was recording yesterday. Now I'm recording today. So anyway, this is a futures contract, December futures contract, right? So all these options are based on December contract right now. They're mostly based on the front month anyway. So that's the front month, okay? Okay, let's go in. So 17 deltas. Let's look at this here quick. I'm selling a vertical. I have to go $20 wide. Now don't worry about selecting strikes. Don't worry about anything else here. Okay, 4160, 4140, fine. Now I just want to show you guys the ticket, the actual amount of money you put down here. So look at this. Now this is because market is closed right now. It's asking me to put down $470 to collect I've collected $112.50. Now again, this is span margining, so it's a little bit off here because what do you call it? The markets are not open right now. It's really early in the morning, and I will show this to you again later, where this thing will go down, buying power effect. But your max loss is 887, and your max profit is 112. Now again, this is the exact same thing I just copied from here to there when I was creating that slide. Anyway, let me take you to SPX options. And let's try and put a trade there. A $10 white trade, 30 days out, right? This is 30 days out. Here I selected 17 deltas. I'll do the exact same here. Okay. 41.50, 41.40. See, I'm collecting roughly the same. Okay. Yeah. 881. Wow. So it's double. I'd say it's usually 2.2 times. Again, but a slightly lower fee. I get it. It's $2 something versus $5 something. But you see the amount of money you're putting down? You're putting down too much money here. You can use this money to put another trade on and make another $120. Anyway, I'm just showing you the comparison to so that you get your head around why we use futures. We save half the amount of money, and because we can recycle that money, we can redeploy that money into different strategies, into other products where we can make more money. So basically the crux of this product, or the crux of our course, is to collect $125 to $150 on each trade when we put it on. When we close it, and I will talk about this later in the course, when we close it at a certain percentage point. You know, that's the risk reward. So for each of our for each of our trade, basically we do not collect more than $150, $175. And each of our trade is basically about this much margining. That's what we do. Thank you, and then I'll see you in the next video.